So Rukun Tanachandani is part of the fund management team at PPFS, and he helps us track the quant stuff that we work with. Today is a very fantastic presentation, very topical. I think all of you must have received the email and topic. Rukun, over to you. Thank you.
So in recent times, there has been considerable interest in the small cap space. We've also had discussions, or we've been asked questions around this space, and this is an attempt to present some of our thought process on this space, as well as see if there is an opportunity in that space, and if there is an opportunity, what are the challenges in capitalizing on that opportunity. So I'll just start with giving some context to the overall space, which will help us in the future sections. So when you look at the listed universe, and for the purposes of this presentation, I'm restricting the listed universe to the top 500 companies. So if you look at the listed universe and you see the profit pool between large cap, mid cap and small cap is just about 8.8% of the overall profit pool. Large cap is close to around 75%, mid cap is close to around 16%. Now, these numbers have been fairly stable over time. So this is not as if, this is the case right now, but more or less small caps have formed something like anywhere between 7 to 10% of the profit pool. You can slice and dice it different ways. You can look at operating profit pool, you can look at FCF pool, but more or less you'll come to the same conclusion that it is somewhere between that 7 to 10%. Now, I want you to remember this number because as we go forward, this will give important context as to what is happening in this space. When you look at market cap overall, large caps are 72% of the overall market cap pool. Mid cap is about 18% today. Small cap is 9.5%. So fairly similar to the profit pool. Now, when I talk about, or when you hear Hrithik, today probably most of you would imagine this Bollywood superstar, but there was a time in 2019 and 2020 wherein Hrithik also, especially for stock market participants, Hrithik also meant these names. And there has been complaints or arguments against the mutual fund schemes that, bulk of the profit, bulk of the AUM gets invested in the large cap space. But when you look at it in context of the previous slides, you have almost 75% of the profit pool and the market cap pool within the large cap space. So it is only logical that a lot of the AUM is getting deployed in that large cap space. Now, on a lighter note, I didn't know this, but 2019-20 were the years of Hrithik and 2022 was the year of Salman. So these were 6 large cap stocks that delivered the best returns. And based on these trends, I think the way to outperform large caps is to identify the right Bollywood superstar. So I'll leave that up to you to find who will be the 2023 one. So now, so S is SBI, X is L&T, Maruti, one Adani Group stock, and NTPC. So when you look at the long-term performance of the small cap index and compare it to a large cap index, here we are looking at BSE small cap and BSE 100. Over these 20 years, the small cap index has given about a 17.4% CAGR. The large cap index has given about a 15.7% CAGR. So that is roughly about a 1.7% alpha CAGR, you can say. Having said that, that excess return has come with extremely high volatility. In fact, if you would have been having this presentation in March of 2020, you had a 17-year period wherein an investor in small cap took all the higher volatility of that space, and yet over that 17-year period, you had returns lower than the large cap index. So the index returns themselves do not suggest a reason to be optimistic. Is is there any academic research that we can look at? Now, especially in quant circles, one of the most cited academic researches is by these 4 professors from IIM Ahmedabad. And basically their study or research said that there is no size premium, or to put it in simpler terms, they did not find any evidence of small caps outperforming large caps over their period of study, which went from 1994, and they have been extending this study. This was till 2015, but they keep on updating it, and based on their study, there is no size premium in the Indian markets. Now, having said that, while their methodology is well accepted within the quant circles, it is quite complicated, and let me just try and elaborate on what they did to arrive at their conclusion. So what they did was they bifurcated the entire listed universe into large caps and small caps, as well as between value, neutral, and growth. And they created 6 portfolios: large cap value, large cap neutral, large cap growth, small cap value, small cap neutral, small cap growth. And then they created 3 long short portfolios, wherein small cap was long, large cap was short. So small cap, long small cap, short large cap value, long small cap value, long small cap neutral, short large cap neutral, and so on. And then they averaged out the performance. Now, while this is an accepted way of doing these studies globally, I think most of us will agree that for long-term, long-only investors, this is not how we invest, or this is not how we look at returns. We'll typically have a portfolio of 30, 40, 50 small caps, or probably higher, and we'll rebalance them over a period of time, review it, and look at that performance. So I wouldn't purely go by the face value or by the results of this study. It's better we do our own analysis to come to a conclusion. So let's see if there is an opportunity in this space. So we start with the small cap universe, which the way now it is defined is stocks ranked from 250 to 500. Again, the conventional or the practice is that every 6 months this universe gets reviewed or rebalanced. So some stocks will go on to become mid caps, some stocks will go on to become micro caps, and some new additions will happen. So every 6 months we'll keep rebalancing it. In this particular case, I take transaction costs and also a 2% impact cost on every rebalance, as well as I factor in dividends. So overall, over the 20-year period, this is something like a 16.3% CAGR, which is not very different from the large caps we saw, so not much to talk about. Now, one factor that has been, especially within quants, that has been extremely popular is the momentum factor. And what momentum tells you is that it's a tendency for stocks that do well in the recent past to continue doing well in the recent future. And again, intuitively, you would have seen that a lot of times a stock catches a market's fancy and it goes on to do much better in the near future. A problem with rebalancing every 6 months is that if your large stocks do well, then they are kicked out of the universe, they become mid-cap, and you forego the possibility to earn an outsized return. So, just as an example, here is the case of Persistent Systems, which was one of the larger small caps earlier. The stock, post the COVID correction, the stock saw a decent run-up, went from something like 500 odd rupees to 1500, 1600 rupees. Had a decent run-up and consequently became a mid-cap. In the rebalance, it was moved out. It was moved in March 21 and subsequently the stock went on to do extremely well. Now, we reviewed the small cap rebalances over the past 5 years. So there have been 70 instances wherein stocks from the small cap index went on to become part of the mid cap index. If you look at the performance of these 70 stocks, 60% of them underperformed the small cap index. So, which is a good thing. The stocks that are going out are underperforming. The problem is that the ones that did outperform the index, the ones like Persistent Systems, they outperformed by a very wide margin. And consequently, even including the underperformance of the other 60%, the average outperformance of these stocks over the subsequent 1% versus the small cap index over that same period was about 4.8%. Again, think of indices like S&P 500, wherein for the past 7-8 years, FANGs have done extremely well. What if at some point of time there was a mega cap index and the FANGs had to be moved out of the S&P 500 to become part of that mega cap index? Then S&P 500 would have lost all that performance. So by selling your big winners early, you're losing out on that opportunity. Now, when on this particular aspect, active mutual funds have an advantage. They are not forced to rebalance their holdings as frequently. Also, they have leeway in maintaining that small cap ratio. So they have to maintain a minimum of small cap exposure. So even if a stock goes on to become mid cap, it's not necessary that they have to sell it. If you look at the different small cap funds, you will generally see that they also have mid cap and large cap exposures. So if you incorporate this, so we started with a universe of 250 stocks and we were rebalancing it every 6 months. Now let's be a bit lazy and let's rebalance this every 3 years. So for 3 years, I don't do anything with that universe and then I rebalance it. So that moves you up from 16.3% to 17.5%. It's a small added advantage, but compounded over 20 years, and most importantly, you are getting that without doing anything, or by doing much less of what you were doing earlier. Can we improve this further? So when you see the small cap space, and let's focus on ROE. So if you see the small cap space, the companies that are earning less than 10% ROE is roughly about 29% of that overall space. This is not as of today, but this is an average over the past 20 years. That same number for the large and mid cap space is about 18%. So many small caps tend to be junk stocks. A problem with this, obviously you want to invest in high ROE companies, but a problem with junk stocks also is that they tend to be extremely illiquid. More importantly, they tend to be illiquid, especially during bad times of the market. So if you see the liquidity in the small cap space without junk, and you see the liquidity in small cap space, only junk stocks, you see that junk stocks are illiquid, but especially during times like COVID or June 20, you see a drastic reduction in liquidity in these stocks, which means if you are holding these stocks, you would incur a very heavy impact cost if at all you are able to find volumes based on your AUMs. So what if we remove this universe or this 30% of the stocks along with stocks that are extremely highly leveraged? So any stock which is more than 5x debt to EBITDA, that moves you dramatically higher. So that universe of small cap without junk stocks, which is rebalanced every 3 years, goes up to something like a 21.5% CAGR. And this is what shows that there is an potential in this space to generate alpha. Again, out of 250 stocks, when you remove the junk stocks, you are still left with a universe of almost anywhere between 120 to 160 or 170 stocks. So this is still a reasonably large opportunity set to look at. The other factor that has been helping or that is favoring small caps over time has been that many of these companies have deleveraged over time. We have seen that happen with large caps as well, but proportionately the amount of deleveraging that has happened in small caps is much higher. So today, many of these companies have much better balance sheets than probably what they had in that 2007 or earlier period. The other reason to consider this space is that there are many sectors or sub-segments of the market which are only present or wherein you can only participate by being in small caps. So segments like commodity exchanges, energy exchanges, MFRTAs, pathology labs, multiplex, logistics, refractories, plywood, textiles, packaging. If you restrict your universe or if you restrict yourself only to the large cap stocks, then these are segments you will not be able to participate in. And a culmination of all these advantages has meant that many small cap funds have been able to outperform the index. Or if you look at the proportion of funds outperforming the respective benchmarks, you've seen that in small cap, that number is much higher. Now we've seen that this space offers an opportunity. However, there are challenges in capitalizing that opportunity. So we saw a reasonably decent backtested return of about, let's say, 21.5%. But the issue is, even in that reasonably high return, there have been periods with severe drawdowns. So, and especially whenever markets are bad, this segment, even if you exclude the junk stocks, even if you exclude over-leveraged stocks, even then your drawdowns will tend to be much higher than what it is in large cap stocks. So, financial crisis, you had almost a 70% drawdown. There was a 6-year period or more than a 6-year period from December 2007 to March 14, wherein an investor in this space would have either had a negative return or probably just about broken even over that 6-year space. Again, from December 17 to December 19, you had a period wherein the space saw a 30% correction versus large caps doing much better. So, this is a space that is prone to high drawdowns. Now, what is leading to these high drawdowns? If you look at the profitability of the space, especially our universe, which excludes the junk stocks, the profitability over time, which here I've measured as the median return on equity, is fairly stable. So, you had a very exceptionally high profitability in that 2003 to 7 period. But other than that, it has been in the range of anywhere between 15 to 18% kind of a range. So, profitability is not very cyclical. What is cyclical is the multiples in this space, which is driven by the investor euphoria and panic that happens in this space. So, if you look at the median multiples in this space, in the 03-08 period, they went from 5.5x to 21x. In the corresponding global financial crisis, that contracted to 5.4x. Again, in that small cap euphoria period of the earlier cycle, we went up to 25x, which corrected back to about 11x. We'll come to where we are now in the subsequent sections. The other problem with this space is that there is lower liquidity. Now, this is fairly intuitive. This is purely a function of your lower market cap pool and lower free float pool. So, the amount of volumes that are available in this space as a proportion of the overall traded volumes is lower versus large caps and mid caps. So, this is fairly intuitive. What is probably not as appreciated is the fact that even this lower liquidity can severely dry up during bad periods. So, if you see the quarter of March 2014 versus December 20, the liquidity in small caps had contracted almost 50%. Similarly, in December 19 versus December 17, the liquidity contracted by almost 1/3. So, especially during bad markets, it might be difficult to get volumes, or you might have a severely high impact cost. Now, if you look at this 20-year period and you try to see what if I pick the small cap stock, what is the probability that over the next 3 years, I will make an absolute return of less than minus 30%, or I will have a drawdown of minus 30% in that individual stock. So that probability for small caps is about 23%, or almost 1 in 4. The same probability for large cap is about 13%. So individual stocks in this space have a higher probability of seeing bigger corrections. Now, some of the reasons why this might be happening is because these businesses are not very well diversified. Again, this is not a generalization for all small caps, but in some cases, these might be true. So companies might have fewer lines of business. Many auto ancillary companies have just 1 or 2 products. If that product or that technology changes, you suddenly see a major impact on revenues and profitability. Many NBFCs or small banks are concentrated in single geographies or couple of states. If that state or that geography goes through trouble, then you might see a drawdown. There might be excessive dependence on a few customers. You see this in the case of mid-cap IT companies, wherein 1 or 2 customers might be having like 30-40% of the overall, contributing 30-40% of the overall revenues. Again, in many cases, because of the lack of scale, you will have very high operating leverage. So if revenues goes up, your margins go up dramatically, and consequently, in a downturn when revenues come down, your margins also compress dramatically and your profits compress multifold. In some cases, there might be a key person risk, or you might not have enough management bandwidth, or you might not have a second level of management, and the decision making might not be very widespread within that organization. So if 1 or 2 individuals or a few individuals in the organization end up making a bad decision, impacts the entire company. Finally, in many cases, we've seen that there is unrelated diversification that happens in these companies, or there is a capital misallocation that happens. Excess cash is not distributed to shareholders in dividends or buybacks. So all these risks, while you might anticipate some of them, it is extremely difficult to mitigate these risks. The only way probably you can mitigate these risks at a portfolio level is by being adequately diversified. So diversification might be essential in this space. So where are we right now? If you look at the inflows into active equity MFs over the last 2 years on a 3-month rolling basis, last 5-6 months, you are seeing disproportionate amount of inflows coming into this space. For the previous 3 months, this number was something like 38%. So 38% of the active MF inflows came to small cap funds. Again, put this into perspective of the profit pool and the market cap pool that is available in this space. Consequently, what has happened is that many funds have become very large in this space. So if you look at this select group of funds from about 40,500 crores 2 years back, this is something like 127,000 crores today. The largest fund in this space is something like 37,000 crores. And many funds are, or quite a few funds are actually bigger than many large caps or flexi cap funds. Now, what has happened as a result of all these flows and the AUM increase is that while this space, the portfolios are generally diversified, the number of stocks has further increased over the past years. So from a median of about 51 stocks, the typical small cap fund today owns something like 77 stocks. Also, as AUM increases, even in spite of increasing the number of stocks in the portfolio, beyond a point, liquidity can start to become a challenge in the space. So if you look at the holdings of individual funds and try to identify how much of the portfolio they can liquidate within different buckets. So how much of the portfolio they can liquidate in less than 1 month, between 1 to 3 months, and so on. You find that in many cases, or at a median, roughly 30% of the portfolio, to liquidate 30% of the portfolio, it might take more than 3 months. In some cases, it's higher. Again, I think the assumption of participating 30% of the overall volumes in a day is fairly liberal. So in a bad market, that volume itself will come down. So if you look at simply the relative price performance of small caps versus large caps, if you see the ratio of BSE small cap versus Nifty 50, which is the large cap index, today that number is something like 1.95. The previous peak was 1.91. The peak before that in 2009-10 was 1.85. So purely based on relative performance of indexes, the space doesn't seem to be cheap. If you look at relative valuations, this is the median EV/EBIT valuation of small caps versus large caps. So typically, a median small cap company will trade at a 24% discount to a median large cap company. That discount today has narrowed down to 9%. Again, previous peaks have been anywhere between -5% to +3%. In some cases, there are times of the market when this discount widens quite a bit, and those are the times when this space might be really interesting. So during the great financial crisis, you had a discount in valuations of almost 50%. During the last downturn in December 19, the discount was almost 33-34%. So those are the times when this space can be really interesting. Today, that discount is not very appealing. If you look at it on an absolute valuation basis, your median EV/EBIT for a small cap stock today is about 24.5 times. The previous peak was about 25 times. And the earliest we've seen. So again, on an absolute basis, this doesn't seem to be a very attractive place right now. So to summarize, the overall space is a small portion of the overall profit and market cap pool, anywhere between 7% to 10%. So as investors, that number is something to be kept in mind as we structure the portfolios. There is an opportunity to outperform by participating in that space if you avoid junk stocks, and also to participate in some segments that are not present in large caps. It requires a long-term time horizon, and it requires being patient with intermediate drawdowns. The space has wild swings in valuations. So valuations can go anywhere from like 11x EV/EBIT to 25x EV/EBIT. And consequently, it is very important to be mindful of the entry valuations in this space. As things stand today, the space doesn't seem to be very cheap. And finally, because of the low liquidity in this space, as well as the high probability of downside in individual names, it is recommended to have some diversification in this space. Yeah, sorry. Thank you.
Thank you so much, Rukun. I'll just...
Excellent presentation, Rukun. Very insightful. So I had a question. Since 2014, I was just going through some data. The median ROE of large cap companies is about 17%. And of, the small cap index is about 15 to 16%. So there isn't a large mismatch there. So how do you see the valuation discount of only 9% in light of this very minimal difference?
So at a median level, yes, there isn't a big difference between ROEs. There isn't a big difference between debt to equity, or you look at other factors like margins and so on. However, median is one number. When you look at individual names, the risk in any individual name is still higher in this space. Especially also you are taking on a risk related to liquidity. So considering all those risks, I wouldn't say that a 9% discount completely justifies taking all those risks within that space. It's also a much more volatile space even at a portfolio level.
Right. So, do you think this 9%, that it may be slightly skewed or maybe slightly misleading given, the corporate governance has improved in small caps and their ratios, etc., have improved drastically. The debt levels, I think, are also almost on par with, the large cap index. So, while you rightly said 9%, may not be the right representation, but do you think it could be closer to, the valuation of the large cap index?
So fundamentally, I don't see any data that suggests that this is better than large cap index. Even if you include ROE, when you look at balance sheets and all, the same thing has happened with large caps as well. So they have also seen a deleveraging. Generally, ROE levels there have also improved. So one can take that view, and I don't think there's a right answer to it. You can take that view that this doesn't merit a discount, but purely because of the limitations in liquidity, purely because of the inherent nature of that business, which is wherein you are not as diversified, wherein you have all those individual risks, this still, in my view, merits probably close to the discount that it has seen. So those factors to a great extent have also remained in the past. So it's not that earlier ROE levels were drastically different between large caps and small caps. Corporate governance is a bit fuzzy, so you don't have a way to quantify it. But more or less, fundamentally, it's not as if that space was very bad earlier and it has now become good.
Just one last question.
Yeah.
Hello. Can you just go back to that slide of 1.95:1?
Sorry. Better.
Yeah, this one. Can you please elaborate slightly on this?
No, this is actually fairly simple. This is simply the BSE small cap price divided by the Nifty 50 price. So it's simply the relative performance of one index versus the other index. When it's higher, it shows that small caps are outperforming. When it's lower, it shows that small caps are underperforming. So there's no great fundamental reason behind this. I mean, if you're looking for a more scientific kind of a thing, then relative valuation or absolute valuation will be a better benchmark. This is just a simple way of depicting it.
Hi, excellent presentation and very thoughtful insights into this segment. My view, just wanted to understand. See, everywhere we hear about Indian economy growing from say $3.6 trillion, say in next about 10 years, it would be around say $10 trillion kind of thing. So when such kind of transformation phase, which we have never seen in the past for decades, at that time, the growth rates of small cap would be larger, medium, mid cap would be little less, and large cap would be even less because large cap already are at a very higher base. So in that case, assuming certain factors like excluding junk stocks and segments, and the segments that you said represent the small case, is there a merit to the case that more alpha would be created in the next 10 years in the small cap, which may transform to mid cap, and mid cap which may transform to large cap? So just wanted to understand if, how do you?
So my view on that is that you've also seen a dramatic increase in economy or GDP over the last 20 years, just like we'll see over the subsequent 20 years. But overall, the profit pools have not dramatically changed. So it's not that 20 years back, the small cap pool was 3% and today it has increased to 8%. The profit pools have still remained more or less stable. If you are... So I don't think you can simply take the view that small caps as a proportion will increase just because the GDP is increasing. Second, if you are indeed taking a 10-15 year kind of a view, one, two, if you are willing to live with all these drawdowns. So again, even during, I didn't show that, but even during the 2003 to 2007 period, there were periods of severe small cap underperformance. So, and obviously over the next 10 years, 20 years, there have been quite a few periods of that underperformance. Again, all the while the economy was growing. So there is no reason to say that this won't happen in the future. So if you have a 15-year horizon, you are willing to take all those drawdowns, and finally you can identify those names which can go from small to mid to large, then it makes sense.
Right.
Obviously, also there is a limitation to participating in this space purely because of the market cap pool, right? So all of us cannot invest 100% of that capital in that 10% and still expect, the space to not have its valuation impacted.
Definitely, that's a prudent. Sir, your view. No. Yeah, so another thing is that just with the premise that small caps will have a larger growth cycle compared to a mid cap, and mid cap will have a larger growth cycle compared to a large cap, the PE re-ratings will happen. Certain segments which are represented in small cap will grow phenomenally as the economy transforms from 3.6 to 5 trillion to 10 trillion, like some of the commodity exchanges or things that you mentioned. So that was one of the views, and
Well, I'll let Rajiv add, but if you see the 20-year period and if you see the valuations of this space versus large cap space, there is no evidence of a continuous re-rating or relative re-rating happening. I mean, this seems like a fairly mean reverting or a stationary chart, right? So again, over this period, many companies have done exceptionally well. The economy has done exceptionally well. So I don't agree with that hypothesis that since the economy will keep doing well, small caps will keep expanding their PEs versus large caps.
Fine. Sir, you had some view, like. No. So I'm.
Sure. So this question comes persistently across time cycles, and the guilt for this lies with probably our industry, the mutual fund industry, because every time we launch a small cap fund or a mid cap fund, the advertisements will have a tiny tiger cub which will grow into a big tiger down the road, or the fantasy is that you will buy a small titan which is just entering the jewelry space, and then it will become this mega cap, and we fantasize about this. So let's look at the base rates. Now things like Titan and all are very, very exceptional companies, and the size of opportunity was such and stuff like that. So maybe 20-25 years back, I don't know when, a car dealership got listed, right? The business of the company was to sell cars of a OEM and to do servicing of that car. Now, will that dealership become Maruti? No, Maruti will remain Maruti, and that dealership will remain a dealership. So, generally, I was going through the list small caps and mid cap companies, and the list is more or less the same that I used to see 20 years back, 25 years back. Now, let us say very, very quality companies, for example, ICRA, which is a subsidiary of Moody's. Now, no problem with governance and all that, but can ICRA become a HDFC bank? No. So it's like this: when you have a particular animal species, that animal species will have some kind of a DNA or genetics. So a human being will never become as tall as a giraffe, right? Both are completely different species. So this persistent thing that if you buy a small cap today, it will become large cap of tomorrow. If you do the percentages, how many companies were there small cap 20 years back and what proportion of them
our large cap today, the percentage would be very, very small in my view.
Thanks. And one more follow-up question I had. So the one chart showed where a company moves to a mid cap from a small cap, and then the exponential growth with a time period. So have you done any analysis that any companies which are growing fast and which move from a small cap to a mid cap, the chances of success and creating alpha is higher on those kind of companies because they are in that momentum phase, right? And they have done something better so that they have become mid cap from a small cap.
So I didn't actually present the exact same thing that you were referring to. And I was only referring to a short-term performance over the subsequent 6 months to 1 year. I think you're referring to
Just a bit, yeah. Just
yeah, I think you're referring to this, right?
Yeah.
So the thing is, this phenomena exists only up to a certain point, which is 6 months, 12 months. Over a longer period of time, a lot of this mean reverts. So I've not done that analysis, but if you do this over a 5-year period, probably this outperformance will go down to 0, probably even negative. I don't know. As Rajiv said, the base rates of so a lot of times what happens is the stock goes up, the small cap index loses that outperformance. At some point of time, things start to go bad. The stock starts to come down, which is wherein the small cap index, it will once again get into the small cap index. So just because a stock has once moved from small cap to mid cap doesn't mean that it continues that journey to go and become a large cap.
Right. No.
Again, if you can identify stocks that are going from small cap to mid cap and to large cap
level lens that we can start looking at, that any company which has moved from small cap to mid cap, does it warrant a detailed scrutiny that it can become a better company for alpha generation in future?
But that is intuitive that it will do better. The problem is that that's an hindsight study. I'm only looking at stocks that have gone from small caps to large caps. These are probably 3% or 4% of that overall universe, or probably even less.
Fine.
So you need to identify them on a prospective basis, which is where the difficult part is.
Again, to answer your question a bit differently, let us say the cutoff region, first 100 stocks are large cap, next 150 are mid cap, next 250 are small caps. Now a stock number 251, if it grows market cap a little, and if stock number 250 loses market cap, they will interchange. Now you will say this has become from small cap to mid cap. Should it persistently do well and become the large cap of tomorrow? There's no such reason. Ultimately, it has to be backed by growing sales, growing profitability, size of opportunity, and various things come into picture. So just because it's moved from one category to the other would be driven by cyclical factors, would be driven by market sentiment, or some larger company temporarily doing badly. Various things could come into picture.
Thank you.
Hello. Yeah. So I just want to add to this discussion, which there is a widespread belief in people. First of all, the HNIs and individual investors, they always believe they can do better than a typical mutual fund, right? So they are not satisfied by the index returns of a large cap index return. Number one. Number two, even the mutual funds are hardly giving, let's say, I mean, I'm just repeating the typical personal belief of many of my friends. So a large cap fund will give another, let's say, if at all, 2-3% excess return over. So because of this kind of a feeling, there are so many PMSs going around, and they are even more concentrated. Like typical PMS would invest in 10 to 12 small caps, So that's how they are marketed. So it will be interesting to see and there is a very large universe, I believe, of PMSs and AIFs nowadays. What is the performance? How many of them are able to even outperform the small cap index? Forget about in general giving a long-term return, and how many how many are able to give it over a longer period of time. So my suggestion would be to add that kind of a, because that's practical data, right?
So I mean that data is to a great extent available if you look at sites like PMS Bazaar and so on. So
so I would,
you can look at that data and take a call how many are outperforming.
So the answer to that is you have to look at that in graveyards, right? So like Taleb says, if you look at only the reported data, that will not include PMSs which have shut shop and are no longer reporting data. So the fastest way to get a huge subscriber base and become rich is to start mailing a newsletter to a million subscribers. Half of them tell buy, half of them tell sell. Okay, the stock will go up or will go down. Wherever you have gone wrong, stop sending them a mail. Again, send a mail to the people with whom you have gone right. Again, give split opinion. Finally, you will be left with a few people who think you have got 5-10 calls right in a row, and then you are a genius, right? And then sell them a stock advisory subscription. Of course, these days SEBI will come after you, but otherwise, in the bad old days, you could get away with such a thing. So concentration can work both ways. It can go right for you or it can go wrong for you. People will look at trailing returns and people will subscribe with someone. But how many people started with that strategy? How many people have actually done well and all that? That is very, very difficult to do. So we have been in both spaces. So we ran a PMS from 97 to 2013, and then we are largely in the mutual fund space. We still have a PMS license going. The reporting over there is not standardized. Firstly, you have various managed accounts. In a lot of things, there are restrictions by the client. They may be employed somewhere where they are prohibited from buying and selling their employer stock, or they may have personal preferences in terms of ethical or religious preferences, or sometimes they may come in with a particular stock and there would be tax implications. So it's not a standardized reporting like a mutual fund structure. So all the numbers that you see are some kind of a khichdi return, average return for all the clients, and the strategies are self-reported and the numbers are not too reliable. So one could have put data here, but that largely is meaningless in that space. It's very, very difficult to come to a correct answer in terms of what PMSs are doing at an aggregate level. I'm not saying all PMS managers are bad. We have been one of the PMS managers in the earlier days. There are some very, very good PMS managers, but aggregate numbers are very, very difficult to come by.
So there is another typical thing which I encounter, and I have been a strategy guy in corporate world. So in strategy, we say that the guys who have big companies which have large market share are difficult to dislodge by small guys, typically, right? And in India, I hear a lot of people looking for the next HDFC Bank or the next Infosys or the next Titan. But HDFC Bank, like, I have not seen in last 20 years any other bank becoming even close to HDFC Bank in terms of those profitability ratios and consistent growth, etc. And people still keep looking, and even the next 10 years, like, people have a belief that HDFC Bank has become too large in terms of market cap, etc. Will it grow as much as smaller banks which can grow faster? So that belief is also there. And I personally believe that the strength of these large banks, 3, 4, 5 banks, is so much that these small guys So by the way, when the HDFC Bank or an ICICI Bank came up, they had only PSU banks and very lethargic PSU banks to compete with. But now a small bank which comes up now has to compete with a 4-5 very agile private sector banks as well as the more agile PSU banks, right? So I'm sure these kind of stories you can talk about in other sectors. Car companies, how many new car companies can compete with the biggies, right? So this also will impact the choice of investing in large caps versus small caps.
Right. So there are sectors wherein there is economies of scale, or wherein the larger you are, there are certain advantages to it. What you've seen is banking is one of them. You find some evidence of that in IT as well. But there are others wherein that is not applicable. So if you go sector by sector, there are definitely places wherein it might make sense to have that exposure through large caps, or wherein the small cap company will not be able to replicate some of those advantages. Banking, as you said, is one of them. Yeah, so go sector by sector is the right way to do it. There are sectors wherein you can have exposure through large caps, but there are also many wherein there is no large cap, or there aren't enough large cap options, wherein there are only mid caps or small caps.
True, I think that's a very good point. However, if there is a sector where a small company has an advantage, will it ever become a large cap? Then that will be a question.
So in many cases, you have seen whatever small caps have become large over time as the market has grown, have grown through that process, right? So I'm sure Titan at one point of time must have been a small cap, or you might have had many of the consumer discretionary companies. They have grown from being small caps to large caps as the space itself has grown, as the consumption in that space has grown. So there will be spaces wherein there is a natural growth of that market, and consequently a small cap does become a large cap.
Thank you.
So I think overall, my own view is that I'm not in any of the extreme camps, right? So in 2019 and 20, there was this, when large caps were doing extremely well, there was this idea that, the large caps, there is a concentration happening. Large caps are getting more and more of the incremental share. There is a consolidation of markets happening. But again, if you look at the data, that doesn't suggest that. So it's not as if large cap profit pools have also grown dramatically. So I think the answer is somewhere in between, wherein each of these three different species, as you might call it, have managed to survive and maintain their shares.
So
yeah, Rahul had a question from the Zoom. Rahul, go ahead.
Yeah, hi. Am I audible?
Yeah.
Okay, wonderful. Thank you very much. Wonderful presentation. Very thought-provoking. This is my first FOF session, so, I'm very excited. I just wanted to say a few things and request your views on the same. Before that, a gentleman mentioned which is the next infy. So for those of us who have gray hair, or in my case, very little hair, throughout the 90s and the early 2000s, the answer really was the next infy is infy, right? So most people forget that. They're looking for a new opportunity and they miss their opportunity right in front of them. So what I'm taking away from the presentation that has been made, wonderful, thought-provoking, is like with any other segment of the market, it is very important to buy when there is gross mispricing. It's very clearly evident. Two, even if you did a basket approach by using simple filters, you could make a phenomenal return. Buffett is making less than 20%. Here, over 20 years, if I'm not mistaken, you made 21% in that bucket, the non-junk small cap bucket.
Right. Buffett is running multiples of that money. So, as I said, even if all of us, if at that point of time all of us tried to put in 100% of our capital in that space, then the valuations would have been very different.
Yeah, but for most of us who are listening in, I think the gross mistake, and even I would call myself a seasoned investor, is the mistake we are making is we're trying to find the big opportunity in small cap, right? When the big opportunity may exist in the large cap, that's one. The other is in the small cap, we are all trying to find the stock which will become the mid cap and not finding a small cap which could be phenomenal as a small cap itself. And I think we miss the woods for the trees, right? That's the mistake we make. So given the case you made, and I think this case can be made at any point in time by you, this leads me to believe that inherently investing in a small cap fund which does not control inflows in the long term may work to the detriment of the investors. Your
Yes.
thoughts on this, if any?
Yeah, so at times of extreme valuations, it would be logical or rational to control inflows in a small cap only fund. There is some leeway wherein you can invest in large caps, you can invest in mid caps and have some cash to the extent of 35%. But at extreme points, wherein especially when liquidity starts to become a challenge, it would be rational to control inflows in a small cap fund.
In fact, give away the money, give back the money, right? Like I would assume what a flexi cap or whatever it's called now, flexi cap funds, diversified funds would do, they would automatically reduce the exposure to a highly overvalued segment of the market. If it's effectively giving away that AUM and moving it to somewhere else, a small cap fund may not have that opportunity. So it's going to ride it to a very large extent.
Yes. Yeah, so what you can do is increase cash levels, or from the investor's perspective, you can reduce your own allocations towards that space at such times. But the fund itself, beyond the point, doesn't have too much of a flexibility.
So the fund may be a good fund and you have to control your exposure and you have to therefore keep track of the valuation, I would say. But those were just my comments and thank you for your views. Back to you guys.
Thank you.
No. Okay. Great presentation, great quant work. I had two questions. Question one was, how have you defined junk in terms of the quant parameters that you've defined?
So anything less than 10% ROE or more than 5x debt to EBITDA or negative cumulative cash flows over a 3-year period. Cash flow from operations over a 3 year.
So have you sort of applied the same benchmark for the large caps and mid caps also in the comparison that you've done? Because you would find similar traits in the large cap also, I would presume.
Yeah, so wherever I've presented a comparison between small cap and large cap in terms of either metrics or something, it is the same filters that are there. So let's say valuations, it is the same filters that are there on large caps as well.
Okay, so you've excluded the junk companies in the large cap also, based on the same parameters that you.
Wherever I've presented my metrics there, in wherever I've presented the index, it is the index. So there I've not made any changes. It's what the index is. But I mean, to give you an example, just
like the initial returns that you've mentioned, between the small cap X junk and the large cap over a 20-year period or the time frame that you've defined.
Yeah, so that is only the large cap index. That doesn't exclude junk. If you exclude junk, it will do better. But the small cap X junk tends to do better than the large cap excluding junk.
Okay. Question 2 was actually a follow-up in terms of the PMS part. Would you have data in terms of how much inflows has come into PMS schemes? Because a large chunk of that moves into the small cap, mid cap space in the last 3 months. So like the chart that you mentioned, which is the MF part. But I think what's also happened is that a large chunk of money has flowed into PMSs in the same period. And which is sort of, exaggerating the problem right now.
Right. We don't have that data, but I think the SEBI PMS section, while it will be extremely cumbersome to do that analysis, you, at least for the major ones, if one wants, you can find the inflows within the I think the current financial year or something.
Would you have some intuitive sense on that? Is it like a similar proportion to what we are seeing in the mutual fund space?
I don't have a number, but what I hear from other EMS managers just is that the inflows have been reasonably good.
Fair enough. Thanks.
Thank you for the presentation. Great insights into it. My question is more on the fundamental aspect, and maybe Rajiv sir can also share his thoughts. So clearly there are some merits in being in this space, but for bottoms-up investors, what additional considerations, if any, would you have in your investment process when you're finding opportunities in the small cap space?
So one is unlike large caps and the larger mid caps, where the companies are widely tracked by analysts as well as news media, and everything is known about them. In the small cap space, there's a lot of importance to groundwork, where you can't take what is published at face value. So you have to do a lot of channel checks and due diligence and stuff like that. So especially if you are managing institutional money, and Rukun had this slide on how long it would take by even taking up 30% of the market volume, either to enter the stock or to exit the stock. In some cases, it exceeded a year. So although these stocks technically are listed and you get a daily NAV, if you are going to be investing in a company where promoters own 60, 65%, 75%, some of them in fact may have friendly parties owning some other stocks, effectively it's akin to a private equity investment. Although it's listed, you may not have exit. Entry may be relatively simple if a block is placed to you, etc. So the due diligence required is far greater in this space than elsewhere. Also, Rukun mentioned the key person risk or management bandwidth. Apart from that, unrelated diversification he mentioned. So, like in the journey of small cap, mid cap investing, I've seen dairy companies getting into mall construction. I've seen a company with a business model of running coaching classes getting into university and government skilling thing, where something which was a negative working capital became a real estate heavy business and working capital sink. So various things happen after you invest in those. So the number of stocks that Rukun mentioned that the funds run, one is because of the sheer size of the AUMs that the small cap funds in India have, but also from the point of view of what I just described. Entry and exit may not be very, very simple. Plus, the individual business risk could be very, very high. So while the aggregate numbers look very, very appealing and you think that you will easily make this 20% return, when it comes to actual execution, suddenly things go wrong out of nowhere. So just like venture capitalists spread their bets across various investments, and a lot of them go wrong, and a few handful of companies give you outsized returns. Small and mid cap is, or rather small cap is like that. A few of the investments will do very, very well for you, but be prepared for some of them to go wrong. And I don't think concentrated investing is the way to go here, unless you are then effectively having a board seat directly or indirectly in that sense.
Hi, thanks for your presentation. Some 70 odd scripts which moved out of the small cap, I think in the beginning.
Yeah.
And was there any qualitative analysis done on them? You know, for example, Persistent you mentioned, I knew they were doing something out of the box. Any other companies which were doing very different things because of which they could come out?
No, nothing. I would say there wasn't any unifying factor. It is simply that if you are within that, let's say 250 to 275, and you see a business up move, you see a strong price performance, you are naturally going to move higher in that index and consequently move into that mid cap space. The ones that did outsized, in hindsight, yes, you can say that, you can see Persistent doing very well. The other one that do it extremely well was Tata LXC. Some of the Adani Group stocks were small caps, went on to become mid caps. So I don't think there is a unifying factor behind identifying those. And I think that's what...
Something different, uniquely different, which the big guys could not do.
Sorry, when you
Tata LXC, for example, maybe they're doing something more into IT or for automotives or something like this, which other companies were not doing.
Nothing. As in, I mean, with each stock, you can find a narrative that fits why that stock gave an outsized return. But I can't find a single reason, or I can't find any strong theme that links them.
Thank you.
Thank you. Thank you, everyone. Thank you, Rukun.
Thank you.
Whenever things got rough, I always remember what my father used to say.
Running a business does test a man, my son. There are ups and downs, glorious highs, and sometimes a low that leaves you feeling defeated.
The character of a man and the character of a business are not very different, are they?
Yes. But when the chips are down, we must stand up, dust ourselves off, and motor on.
Volatility. It's a funny thing. It makes you question yourself and wonder if you've made all the right decisions.
Sure, you can question some of your decisions, but stay steadfast on your goals.
Dad always said, there are no shortcuts and no quick profits.
There are no free lunches, are there? There is only one
right way.
At PPFAS, we think like Rahul and his father. That volatility is a fact of running a business. And buying equity shares is like owning a part of that business. We use value investing principles to manage your money. This means we invest in the right businesses at reasonable prices and for a longer term.
PPFAS Mutual Fund. There's only one right way. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.